All right, this is a senior retirement systems analyst, and I need you to stay with me for the next few minutes. What I'm about to walk you through is not speculation, it's not theory, and it's not another viral panic story designed for clicks. This is about a procedural shift happening right now in the digital payment infrastructure that directly affects how retirement accounts, Social Security deposits, and pension distributions move through the financial system. Payment applications, the platforms that 87 million Americans use to receive and transfer money, have begun implementing account restrictions and freezing mechanisms that were not part of the original user agreements most people signed. I'm talking about Venmo, PayPal, Cash App, and Zelle. These are not small regional services. These platforms processed over $1.9 trillion in transactions in 2024. And starting in January 2026, the Internal Revenue Service began requiring these platforms to report all transactions over $600 annually to the federal government under new 1099-K rules. But here's what's not being discussed in the mainstream financial press. The compliance mechanisms these platforms are using to meet that reporting threshold are creating automatic flagging systems that freeze accounts, delay transfers, and in some cases hold funds for up to 180 days without clear recourse. This is not a policy that affects young gig workers sending rent payments. This affects retirees who receive rental income through these platforms, pensioners who split expenses with adult children, and Social Security recipients who use digital wallets to manage their monthly budgets. The timeline matters. The rule change went into effect on January 1st, 2026. And in the 6 weeks since implementation, consumer complaints to the Consumer Financial Protection Bureau regarding frozen payment app accounts increased by 340% compared to the same period in 2025. These are not isolated incidents. These are systemic procedural changes in how digital platforms interact with federal tax reporting requirements. And the downstream effect is that money that retirees believe is accessible, liquid, and under their control is being temporarily or indefinitely restricted based on algorithmic compliance triggers that most users don't understand and cannot predict. Over the next 25 minutes, I'm going to walk you through the exact regulatory timeline that led to this point, the specific mechanisms that cause accounts to be flagged or frozen, why this creates a structural risk for anyone over the age of 60 who uses payment apps for anything beyond occasional personal transfers, and most importantly, what steps you need to take this week to ensure that your retirement income streams are not sitting in platforms that can restrict your access without notice. This is not about avoiding taxes. This is not about hiding money. This is about understanding the procedural reality of how these platforms operate under the new reporting framework and making sure that your monthly cash flow, the money you need to pay bills, buy groceries, and cover medical expenses, is not subject to algorithmic holds that take weeks to resolve. So turn off distractions, grab something to write with, and let's break this down step by step because the timeline is compressing and the window to reposition is narrowing. Before we go into the current rule changes, you need to understand the foundational framework that governs how payment applications are regulated and why that framework creates specific risks for retirees that don't exist for younger users. Payment apps are not banks. This is the single most important distinction that most people miss. When you deposit money into a checking account at a federally insured bank, that deposit is protected by the Federal Deposit Insurance Corporation up to $250,000 per account. The bank is required to hold reserves. It's subject to banking regulations, and if the bank fails, your deposit is guaranteed by the full faith and credit of the United States government. Payment apps operate under a different structure. They are classified as money transmitters, which means they are regulated at the state level, not the federal level. And the funds you hold in a payment app account are not FDIC insured unless the platform has a specific partnership with an underlying bank and you opt into that feature. Most users don't. What this means in practice is that when you receive a Social Security deposit, a pension payment, or a rental income transfer into a payment app, that money is sitting in a non-bank account with limited regulatory protections. If the platform freezes your account for compliance reasons, you don't have the same dispute resolution rights you would have with a traditional bank. The hold can last 30 days, 60 days, or longer, depending on the platform's internal review process. And during that time, you have no access to the funds. This isn't theoretical. According to a 2024 study by the Pew Charitable Trusts, 41% of Americans over the age of 55 now use at least one digital payment app regularly. And of that group, 23% have experienced some form of account restriction or delayed transfer in the past 18 months. The reasons for these restrictions vary. Sometimes it's a security flag because a transaction pattern looks unusual. Sometimes it's a compliance flag tied to anti-money laundering rules. And now starting in 2026, it's increasingly tied to IRS reporting thresholds. The core thesis here is simple. Payment apps were designed for convenience, not for managing retirement income. And as regulatory reporting requirements expand, the friction between how these platforms operate and how retirees need to access their money is creating a procedural mismatch that puts monthly cash flow at risk. If you are using Venmo to collect rent from a tenant, if you're using PayPal to receive reimbursements for shared expenses, or if you're using Cash App to split costs with family members, you are creating a transaction history that now triggers federal tax reporting. And the platforms are responding to that reporting requirement by implementing automated compliance systems that don't distinguish between a retiree splitting a medical bill and a business owner avoiding taxes. Now let's go back and establish the regulatory timeline because this didn't happen overnight. The reporting rule we're dealing with today was created by the American Rescue Plan Act, which was signed into law in March of 2021. The original language of the law required third-party payment platforms to issue a 1099-K form to any user who received more than $600 in gross transactions during a calendar year. For context, the previous threshold was $20,000 in 200 transactions. That was the rule from 2011 through 2021. The shift from $20,000 to $600 represents a 97% reduction in the reporting threshold. And it was designed to close the tax gap, which is the difference between taxes owed and taxes actually collected. The IRS estimated that underreporting by individuals using payment platforms cost the federal government approximately $30 billion annually. So the logic was straightforward. Lower the reporting threshold, increase visibility into digital transactions, and capture more taxable income. The law was passed in 2021, but implementation was delayed. The IRS postponed enforcement to 2023, then again to 2024, and finally to January 1st, 2026. Those delays were not about operational readiness. They were about political and logistical pushback from both the platforms and user advocacy groups who argued that the $600 threshold was too low and would sweep in millions of non-taxable transactions like reimbursements, gifts, and personal transfers. But the delays ended. On January 1st, 2026, the rule went into full effect, and every payment platform operating in the United States is now required to report gross transaction volumes over $600 annually to the IRS via Form 1099-K. The form is not just sent to the IRS, it's also sent to the user. So if you received $650 through PayPal in 2025, you will receive a 1099-K in early 2026, and the IRS will receive a copy as well. Now here's the first procedural problem. The $600 threshold is a gross number, not a net number. If you sent $500 to a friend and they sent you $500 back, that's $1,000 in gross transactions even though your net position is zero. The 1099-K will report $1,000. It doesn't distinguish between income, reimbursements, or gifts. The IRS has issued guidance stating that users are responsible for determining which portions of the reported amounts are actually taxable. But the burden of that determination falls on you, not the platform. And if you don't report the income correctly, you could face penalties or audits. For younger users, this is annoying but manageable. For retirees, especially those on fixed incomes who are already navigating required minimum distributions, Social Security taxation thresholds, and Medicare premium calculations, this introduces a new layer of complexity that can have downstream consequences on tax liability and benefit eligibility. The second procedural problem, and this is where account freezes enter the picture, is how the platforms are implementing compliance to meet this reporting requirement. Payment apps are now using automated monitoring systems to flag accounts that approach or exceed the $600 threshold. These systems are designed to verify user identity, confirm taxpayer identification numbers, and ensure that the platform has the information required to issue the 1099-K form. If there's a mismatch, if your name on the payment app doesn't exactly match your name on your Social Security card, if your address is outdated, if your tax ID number was entered incorrectly, the system flags the account, and the flag triggers a review process. During that review, the platform may freeze the account or restrict certain functions until the discrepancy is resolved. This is not a bug. This is the intended compliance mechanism. The platforms are legally required to verify information before issuing tax forms, and they are erring on the side of caution to avoid penalties from the IRS. But the impact on users, particularly older users who may not check their app notifications daily or who may not have the documentation immediately available, is that accounts get locked without warning. According to data from the Consumer Financial Protection Bureau, complaints related to frozen or restricted payment app accounts increased by 340% in the first 6 weeks of 2026 compared to the same period in 2025. The most common complaint category was inability to access funds due to identity verification holds. The average resolution time, based on CFPB case data, was 23 days. That's 3 weeks without access to money that the user believed was liquid and available. For a retiree who is using a payment app to receive rental income or who split a large expense with a family member, a 23-day hold can mean missed bill payments, overdraft fees on linked bank accounts, or emergency borrowing to cover short-term cash needs. This is a structural risk, not a theoretical one. Now let's talk about the specific scenarios that create the highest risk for retirees and why these scenarios are more common than most people realize. The first scenario is rental income. If you own a rental property and your tenant pays rent through Venmo or Zelle, those payments are gross receipts. If the rent is $800 per month, you will exceed the $600 threshold in the first month. The platform will issue a 1099-K reporting the gross amount, but rental income is already reportable on Schedule E of your tax return. So the 1099-K is redundant from a tax perspective, but it creates a compliance checkpoint for the platform. If your account information is not up to date, the platform may freeze deposits until you verify your identity and tax status. And during that freeze, your tenant may send the payment, but you cannot access it. The second scenario is family expense sharing. Many retirees split large expenses with adult children. Medical bills, home repairs, travel costs. If you receive reimbursements for those shared expenses through a payment app, those reimbursements count as gross receipts even though they are not income. A $5,000 medical bill split with 2 adult children means you might receive $300 in reimbursements through the app. That's well over the $600 threshold. The platform reports it, the IRS sees it, and now you have to document on your tax return that the amount was a reimbursement, not taxable income. If you don't, or if you make an error, you could trigger an audit or a mismatch letter from the IRS. The third scenario is Social Security and pension deposits. Some retirees, particularly those who are unbanked or underbanked, use payment apps as their primary account for receiving government benefits. The Social Security Administration allows direct deposit into certain payment app accounts if the app has a banking partnership. But if the app freezes the account for compliance reasons during a deposit window, the payment can be delayed or returned to the SSA. And once a direct deposit is returned, it can take 2 to 4 weeks to reestablish the deposit routing. During that time, the retiree has no income. These are not edge cases. According to a 2025 survey by AARP, 19% of adults over the age of 62 use payment apps to receive some portion of their monthly income. And of that group, 34% have experienced a delayed or frozen transaction at least once in the prior year. Now let's walk through the exact mechanism that causes an account to be flagged or frozen under the new reporting rules, because understanding the trigger points is the only way to avoid them. Payment platforms use a system called transaction monitoring, which is required under federal anti-money laundering laws and is now also being used to enforce tax reporting compliance. The system tracks 3 primary data points: cumulative gross receipts, transaction frequency, and account verification status. When your cumulative gross receipts exceed $600 in a calendar year, the platform automatically flags your account for 1099-K issuance. If your account verification status is incomplete, meaning your name, address, date of birth, or tax ID number has not been confirmed, the platform initiates a verification hold. This hold prevents you from receiving new payments until you upload documentation. The documentation requirement varies by platform, but typically includes a government-issued photo ID, a social security card or tax identification number, and proof of address such as a utility bill or bank statement. For younger users who are digitally native, uploading these documents through a mobile app is straightforward. For older users, particularly those who are not comfortable with smartphone cameras or who do not have easy access to scanners, the process can be a significant barrier. And if the documents are not uploaded within a certain time frame, usually 14 to 30 days, the platform may restrict the account further or close it entirely. According to PayPal's published support data, approximately 6% of accounts that reach the $600 reporting threshold experience some form of verification hold. With over 87 million active users in the United States, that translates to over 5 million individual account restrictions annually. The second trigger is velocity. If you suddenly receive a large number of transactions in a short period, even if the total amount is below the $600 threshold, the platform's fraud detection system may flag the account. This is common for retirees who receive lump sum reimbursements or who participate in group gift arrangements. The flag triggers a manual review, and during that review, the account may be temporarily restricted. The restriction typically lasts 3 to 7 business days, but can extend longer if the review requires additional information. The third trigger is source of funds. If the payment originates from a new sender, from a foreign account, or from a business account, the platform applies additional scrutiny. The platform may request documentation proving the legitimacy of the transfer, and until that documentation is provided, the funds are held in pending status. Now let's talk about the second order effects, because account freezes do not happen in isolation. When a payment app freezes an account, the user typically has other financial obligations tied to that account. If you have automatic bill payments linked to your payment app balance, those payments will fail if the account is frozen. The failure can result in late fees, service interruptions, or negative marks on your credit report. If you have a linked bank account that is used to cover overdrafts and the payment app freeze prevents a transfer, your bank account may go into overdraft, triggering overdraft fees. If you are using the payment app as a temporary holding account before transferring funds to a brokerage or savings account, the freeze delays that transfer. And if the delay pushes you past a contribution deadline, such as the April 15th deadline for IRA contributions, you lose the tax advantage for that year. These cascading effects are particularly damaging for retirees on fixed incomes who operate on tight monthly budgets. A 3-week freeze on $800 of rental income can force a retiree to choose between paying a mortgage, buying prescription medications, or covering utility bills. According to a 2024 report by the National Council on Aging, 40% of Americans over the age of 65 live on incomes below 200% of the federal poverty line. For that population, even a temporary loss of access to $500 or $1,000 can be catastrophic. So what are the specific steps you need to take right now to ensure that your retirement income and monthly cash flow are not sitting in accounts that can be frozen without notice? The first step is to conduct an immediate audit of where your money is held and how you are using payment apps. Go through every payment app account you have and identify which accounts are receiving more than $600 in gross receipts annually. If you are receiving rental income, consulting fees, or large reimbursements through a payment app, that account is at risk of triggering the reporting threshold and the associated verification holds. The action is to move those income streams to a traditional bank account where you have FDIC insurance and where account restrictions are subject to more robust regulatory oversight. If you are using a payment app to split expenses with family members, establish a different method. Use direct bank transfers, write checks, or arrange for one person to pay the full amount and settle the difference offline. The goal is to keep your gross receipts in payment apps below the $600 threshold to avoid the compliance triggers entirely. The second step is to verify your account information on every platform you use. Log into each payment app and confirm that your legal name, address, date of birth, and tax identification number are accurate and up to date. If there are any discrepancies, correct them immediately before the platform flags your account. Most platforms allow you to update this information in the settings menu under Account or Profile. If you are unsure how to do this, contact the platform's customer support and request step-by-step instructions. Do not wait for a verification hold to be initiated. Proactive verification is far easier to complete than reactive verification during a freeze. The third step is to unlink your payment apps from automatic bill payments. If you currently have utility bills, credit card payments, or subscription services set to pull funds from a payment app balance, change those payment sources to a traditional bank account. This creates a buffer so that if your payment app account is frozen, your critical bill payments are not disrupted. The fourth step is to reduce the balance you hold in payment app accounts. Payment apps are designed for transaction flow, not for long-term storage. If you are holding more than a few $100s in a payment app at any given time, transfer those funds to a bank account where they are FDIC insured and where you have more control. The fifth step is to establish a backup funding source for short-term cash needs. If a payment app freeze cuts off access to funds for 2 or 3 weeks, you need to have an alternative source of liquidity. This could be an emergency savings account, a line of credit, or a family member who can provide a short-term loan. The sixth step is to document everything. If you receive a 1099-K form for amounts that are not taxable income, you need to maintain records that prove those amounts were reimbursements, gifts, or other non-taxable transfers. Keep receipts, bank statements, and written agreements. Work with a tax preparer who understands how to reconcile 1099-K forms with actual taxable income and who can help you avoid triggering a mismatch with the IRS. The seventh step is to understand that payment apps are not a substitute for a banking relationship. Banks are regulated, insured, and required to provide customer service and dispute resolution under federal law. Payment apps are not. If you are relying on a payment app as your primary financial account, you are taking on risks that you do not need to take. Open a checking account at a credit union or a community bank, establish direct deposit for Social Security or pension payments, and use that account as your financial hub. Now let's talk about what happens next, because the regulatory environment is not static. The $600 reporting threshold is currently in effect, but there is ongoing debate in Congress about whether to raise it. Several proposals have been introduced to increase the threshold to $5,000 or to exclude certain types of transactions, such as personal reimbursements and gifts. As of February 2026, none of those proposals have been enacted into law. The IRS has also indicated that it will issue additional guidance on how to distinguish between taxable and non-taxable transactions reported on 1099-K forms, but that guidance has not been finalized. In the meantime, the platforms are operating under the current rule and the compliance mechanisms are in place. The timeline for potential changes is uncertain. If legislative relief comes, it will likely not take effect until 2027 at the earliest. Until then, the $600 threshold remains the operative rule. The second trend to watch is the expansion of IRS enforcement capacity. The Inflation Reduction Act of 2022 allocated $80 billion to the IRS over 10 years, with a significant portion earmarked for increased audits and compliance enforcement. The 1099-K reporting rule is part of that broader enforcement strategy. As the IRS processes the data from millions of 1099-K forms, they will be looking for patterns of underreporting and non-compliance. Retirees who receive 1099-K forms and who do not properly account for those amounts on their tax returns are at higher risk of receiving automated mismatch letters or audit notices. Here's the question I want you to consider carefully. Are you currently receiving any portion of your monthly retirement income through a payment app? And if so, have you verified that your account information is accurate and that you understand the tax reporting implications of the amounts you receive? The data shows that 19% of retirees are using these platforms for income, but most have not updated their account verification or reviewed how the $600 threshold affects them. If that describes your situation, the time to act is this week, not next quarter. The payment app reporting rule is in effect. The account freezes are happening. The question is whether you are going to reposition before the next wave of compliance holds, or whether you are going to discover the problem when you cannot access your money. The window to act is open, but it is narrowing.